He is Laurence Mutkin. He is head of European fixed income at Morgan Stanley. First of all, welcome today. There has been talk about comparing this situation to 2008. What are the fundamental differences as you see them?
Well, several. First of all, although we've had some rise in interbank rates and some rise in the Libor OAS and other technical parts of the market, the rises that we've had are much, much smaller than their equivalent in 2008. The second thing is, of course, already since the second weekend of the month, we've had the ECB back in with its FX swap lines to give unlimited dollars at a rate which is kind of a penalty rate, but nonetheless unlimited dollars against European collateral. And we've got lots of money available from the ECB every week. And thirdly, when you see what the banks are doing, everywhere we look, we can see there is stacks of money washing around in the European and indeed in the US banks. Not maybe all in exactly the right place, but there is, compared to 2008, the amount of liquidity already there is huge.
So are there any circumstances under which you are worried that the Libor would soar from where it is now?
Well, I don't know. Soar's a big word. No, not soar. I think it could still rise a little bit. I mean, to be clear about it, US dollar Libor has risen to just over 50 basis points, a rise of, say, 20, 25 basis points from its lows over quite a long period. It's, in absolute terms, it's still quite a small level. But it's still well below where it could get to because of where the ECB's intervention level really is. But I don't think it's going to get up that far. And if you look at the pace of rise over the past couple of days, it's actually slowed from where we were at the end of last week.
So were you concerned about the exposure of banks to sovereign debt?
Yes, I think we should be. I think we should be for two reasons. First of all, because as the markets have been coming to terms with over the past month, sovereign debt is not as secure as perhaps we thought it was. And the second reason is banks do own a lot of sovereign debt on their books. So both of those things are bad, potentially bad for the capital and for the solvency of banks. But that's a different thing from what we saw last year. Last year was about the very liquidity of the banking system, whether payments would break down, whether your ATM would work. That is so far away from the difficulties facing the banks now. It's a different order of stress.
Indeed. And if we look at the sovereign debt issue, do you think that that bondholders are going to face some kind of restructuring? And if so, that will obviously affect the banks.
Well, I tell you what, I've been speaking in the last month to our colleagues in the emerging market government debt markets a lot, who obviously have a great deal more experience than we do of how you deal with sovereign defaults. And there are a couple of lessons that you can take away from those guys. And perhaps, the first one is that whatever you believe the end game might be, the path to that end game is extremely choppy and rocky as markets receive news about fiscal austerity, which is encouraging, receive worrying news about growth, which is discouraging, and the path to the end game, whatever it may be, is remarkably difficult to read. So, to be honest, I don't know, and neither does anyone else, whether restructuring will be necessary in sovereign markets. But I will say this: the news flow could not have gotten much worse during, say, the past 4 to 6 weeks, and now the news flow, I think, is beginning to get better. I think the market should be becoming less worried than they were before these fiscal reform programs started being rolled out by the governments in question.
Tim Geithner seemed to be concerned when he was over here that the austerity measures might almost be going too far to slow the economy. Just briefly, we do need the austerity measures.
You've got to get the balance right. You've got to have the austerity to bring the debt down. You've got to have growth to enable the governments to pay off the debt in the end. You've got to balance it correctly.
Laurence Mutkin, thank you very much indeed for joining me.